Why investors are suddenly focused on the front end of the yield curve? Good day, everyone. Welcome to the video of the day. So, investors may want to focus on the front end of the yield curve. That's an actual headline from this week. It sounds like a foreign language, but it's actually a simple idea wrapped in Wall Street jargon. Let's translate it. So, we'll start with the meaning of what the yield curve even is. Here's the plain English version, and the government borrows money by selling treasury bonds, some that pay back in 2 years, some in 10 years, some in 30 years. And the yield curve is just a chart plotting the interest rate and the yield for each of those time periods side by side. The front end simply means the short term side of the chart, and the bonds are maturing in a year or a two. And the long end means the 30-year bonds way out on the far right of the chart. That's it. No hidden complexity. The short term versus long term government debt plotted on one chart. Now, the second discussion is why the front end is getting attention right now. Here's why the specific chart is in the news this week. The 30-year Treasury yield just hit its highest level since 2007 as the Federal Reserve held interest rates steady. And some Fed officials have openly said that further rate hikes might be needed too. That created a genuinely strange environment, and markets are now pricing in a couple of possible Fed rates hike over the next 2 years. That's a real reversal from the rate cut expectations investors has pride in long term ago. So, according to the All Spring Global Investment Strategist Noah Weiss, the shift creates an opportunity specifically in short term treasuries. And his arguments is that short-term yields are swinging around as the markets reprice the Fed expectations between meetings, and right now you can get a yield north of 4% on a short-term bonds with relatively low risk. His plain English summary is that opportunity always locks when uncertainty is found. Now, the trade-off: why not just buy the highest yield, and why you should focus on even the lowest yield also. Here's the part that trips people up: why not just buy the 30-year bond if it's paying the most? And the answer is the concept called duration. How sensitive a bond's price is to interest rate change, and the longer maturity bonds swing much harder in price when rates move in either direction. That's exactly what been pushing the holders of 30-year treasuries recently, even though the yield itself looks attractive on paper. And the other side, short-term bonds don't have that problem. The price barely move even when rates shift because they mature so quickly anyway. That's a core trade-off. And the front-end bonds give you steady income, which much less price volatility, while the long-end bond carry more risk of losing the value in rates moving against you about the maturity. So, what does this mean for you as a financial part of the angle? So, here's the practical takeaway: if you're managing or own bond investments or watching a bond fund inside your retirement account right now, professional strategists are specifically favoring the front end of the belly of the curve. That means that bonds in the range of 2 to 7 year are a way to capture attractive yields while limiting exposure to the kind of price swings hitting longer date bonds. If your portfolio or 401k includes bond funds, it's worth checking whether they are weighted toward short term or long term. And treasuries are right now pushing it. That position determines how much price volatility you are exposed to while the Fed's next move stays uncertain. To conclude, the front end of the yield curve just means that short-term government bonds and are attractive yields with the less price risk. That's why the investors are pointing there right now. Subscribe for more of these jargon translations. Welcome to Money Brief. Let's grow together.